Well, for more now on Moody's Move on Ireland, we're going to go live to Dublin to find out what the downgrade means. Rossa White joins us from Davy Research. Rossa, thanks for joining us this morning. And from what John was saying there, it almost sounds like the downgrade has been brushed away. Was it widely anticipated?
Well, you have to go back to last summer, and at that point Moody's downgraded Ireland last July, and they had us on negative outlook. So in a sense, it was expected, given that S&P were one notch lower than Moody's, and they'd moved a year ago too. And that negative outlook tends to feed through to a downgrade. It's rare that you can avoid that fate. So I think, you would say it was fairly well expected. The question was timing, when rather than if, I think.
And, I mean, one of the things that they were talking about was the weak growth prospects. Now, Ireland's been doing relatively well on the export side of things with a weaker euro, but not much signs of growth elsewhere.
Yeah, I think that's fair. I think we would categorise it as being a two-speed economy at the moment, where the export sector is doing very, very well, boosted by global demand. More recently, you would say in the last couple of months, probably boosted by the weaker euro, albeit there are lags involved there. That probably won't kick in for another month or 2 months in a really meaningful way. But yes, domestic activity is still sluggish. So you're seeing export growth without really this strong pass-through to investment and consumer spending. And I think the domestic economy, while it has stabilised, the first quarter numbers were instructive that GNP failed to grow, and that's national income. I think you'll get growth in the second quarter, but it will be modest. So you're seeing this gap widening now between the GDP numbers, which reflect the strong exports, and the GNP numbers, which tell you that the domestic economy, while it is stabilising, it is struggling to post meaningful growth at this point.
And of course, that the difference between the GNP and the debt is a very worrying indicator, and it looks fairly frightening from the Irish side.
Well, the debt to GDP ratio has increased significantly, and one point that Moody's made in their note this morning was that it could stabilise at about 95 to 100% of GDP in 2012, 2013, and that wouldn't differ too much from our forecasts. I think the first point you have to get to is the deficit stabilising. So the underlying deficit now is stabilising if you take out the banking hits. The second stage then, of course, is to stabilise the debt, and I don't think we'll quite get there until 2012. And it will stabilise just below 100% of GDP at that point.